Hello everyone, welcome to this video on NISM Series 8 Equity Derivative Certification Examination. In this video, I am going to help you with mock test on option trading strategies. Option trading strategies in fact is one of the chapters of this module, and by doing these 10 questions which we are going to discuss shortly, you will be able to uh, get an understanding of various types of option strategies. My request to all of you would be that in case you like the content, please subscribe to my channel and refer this channel to your colleagues, friends also. So let me start now by taking up the first question. So as you can see here, this is a question which is talking about an option strategy. It says a person buys a call option and put option with the same strike price of ₹100 for both the options. So it's very clear that the strike price is same. He pays a premium of 8 and 12 respectively for call and put option. Both the options have same expiration date. What kind of option strategy is this, and what would be the maximum loss? So here in this particular question, you have two things to think about. One is the nature of the strategy, and second is the maximum loss. So when you buy a call and a put option with the same strike price and the same expiration date, this kind of option is called as the straddle. So it's a long straddle for sure, because both options have been purchased here. And since the premium of 8 and 12 have been paid here, we will define it as a long straddle strategy, and the cost would be 20. So this would be the answer here. So that's the answer for the first question. Let me move ahead and talk about the second question, which is in a way linked to the first one also. What does it say? A person buys a call option and a put option with a strike price of 100 for both the options. He pays a premium of 8 and 12 respectively for both the options. Both options have the same expiration date. So it's very clear that the options are again the straddle. This is helping creating the straddle strategy. What is the break-even point of the trader in this case? So the break-even point will basically get created on two sides, on upside as well as on downside. So the total premium paid is 8 plus 12, which is 20. So when we calculate the break-even point, we'll have to see what is the break-even point on the upper side of the movement and downside of the movement. So in this particular question, the answer would be 120 and 80. So the strike price being 100, the market must move up by 20 rupees on upside and must fall down by 20 rupees on the downside for the trader to get benefit from this. That is why this answer is 120 and 80. In which of the following situations short straddle strategy would work most efficiently? This is the question, which is more, or rather most effectively. A short straddle strategy is just opposite of a long straddle. So in a long straddle, we are buying a call and a put. In a short straddle, we are selling a call and a put. So if there is a bullish market, you will have a loss. So you will not go ahead with this particular strategy, because a bullish market and a bearish market would create a loss. And a volatile market also will, you never know which way the market would move. So it would be great to have the market in a particular range, and the range bound market would help the market participants to make money from this particular strategy, because you will retain the premium. That is the reason. We move on to the next question, which is about what is the maximum potential gain the trader can incur in case of a short straddle strategy. Now, point to be noted is that a short straddle strategy is created by selling a call and a put option. So when you are selling a call and a put option, as a seller of call and put, what you would receive is the premium. Okay, so what would be your maximum gain? So maximum gain would be sum of the premium received by him on call and put option. It cannot exceed this limit. It cannot be unlimited, because he is selling both call and put. So since he is selling the call and put, he would receive that particular premium. The next question is about how is the long strangle created. Okay, so when you create a long strangle, what you do is that you can create it with out of money call and out of money put options. It's a strategy where you are incurring a very small cost. Okay, which means if you are creating a strangle with out of money, the premium would be less. Okay, so what you do is that you combine two things. One is the out of the money call, and second is out of the money put. Both of them together will help you to create a long strangle. Moving further on the question number 6, it says Mr. X has created an option strategy by buying one call with a strike of 6,200, buying another call with strike of 6,400, and selling two calls midway with a strike price of 6,300. This kind of a strategy when you create, okay, when you have one buy of a lesser strike and one buy of a higher strike, and in between you are selling two call options, it would be called as a butterfly spread. This kind of a strategy is butterfly. So the answer to this would be the butterfly spread. We moved on to the next question, which is quiz 7. So it says covered call strategy is considered similar to what? I mean, when you create a covered call strategy, you have the stop with you and you have sold a call option. So basically this becomes like a short put strategy. What is the short put strategy? In case of a short put strategy, you retain the premium if the market moves up to a limit only. After that you start making loss. So in a covered call strategy also you start making loss in a similar way. The question number 8 is about an investor buys 100 shares of a company with at a price of 2000 each. He buys 100 lots of put option on the same stock with a strike price of 2000 and premium of 10 each. What would be his maximum loss from this transaction if spot price reaches 1000, ignoring the transaction cost? So one important aspect that we need to know here is that, when you buy a put option, your loss gets fully covered after the market falls. Okay, so what you end up losing is only the premium. So the premium being 10 here and this lot being 1000, the total loss that the creator of this strategy, which is protective put, will make a loss of 1000 only. So the answer for this would be 1000. We move on to question 9 now. Which of the following strategies created by holding an underlying stock, buying a put buying an out of the money put option and selling an out of money call option? This kind of a strategy where you are working on stock, put and call option, you are basically creating this strategy, which is called as the caller strategy. In case of covered call, you only use the call option. In case of protective put, you only use the put option along with the stock. Butterfly can be created with call and put both, but to have the stock and combine two options, you will need to you end up creating what is called as the caller strategy. The 10th question is, in which of the following strategies downside risk is limited? So when you buy a covered call, you can make a huge amount of loss as the market falls. Short straddle and short strangle, as the name suggests, they are about selling the call options. Okay, so here also your loss would be unlimited. Protective put is a strategy which limits your loss. So these were the 10 questions that I have discussed in this video quickly. In case you have liked the content of the video, please do subscribe to my channel and write to me on healthofmywealth@gmail.com for any queries that you may be having. Thank you.